Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, and welcome. Today we are getting right into the weeds of accounting to tackle a classic rivalry, US GAAP versus IFRS. But we're going to get super specific and focus on how they handle inventory. Now I know, it sounds technical, but trust me, these rules can completely change the story a company's financial statements are telling.
All right, so here's our game plan for this explainer. First, we're going to look at the common ground where these two rulebooks actually agree. Then, we'll dive into three huge differences: the famous LIFO divide, how they measure the value of inventory, and whether you can reverse an inventory loss. And to wrap it all up, we'll see how all this technical stuff really impacts the bottom line. So before we jump into the disagreements, let's talk about where they actually see eye to eye. It's really important to get that, these two massive frameworks, they're not from different planets. They're actually built on a pretty similar foundation when it comes to inventory. So both systems really start from the same basic idea. Inventory is recorded at its cost. Simple enough, right? They even use similar techniques to figure that cost out, and they agree on what counts as a cost, the direct stuff like materials and labor, and what doesn't, like the CEO's salary or Super Bowl ad. Having this shared starting point is what makes their differences so interesting.
Okay, let's get to our first major clash. And honestly, this is probably the most well-known disagreement in the entire world of inventory accounting. It's all about how you assume your products are being sold. So what exactly is LIFO? It stands for last in, first out. Just picture a shelf at a store. If you're using LIFO, you assume you're selling the brand new item you just put on the front of the shelf, not the older one that's been sitting in the back. Now think about it. If prices are going up, this means your most recent, most expensive costs are what you're counting first, which can have a huge effect on your reported profit.
And this is where the difference is just, well, it's black and white. US GAAP says, sure, you can use LIFO, but IFRS says absolutely not. It is explicitly banned. This is a massive split. IFRS makes companies stick to either FIFO, first in, first out, or a weighted average method. Plus, it demands that you use the same formula for all similar types of inventory. Why? For consistency.
All right, next up, let's talk about something every business dreads. What happens when the stuff you have sitting in a warehouse is suddenly worth less than what you paid for it? This is such a critical question in accounting, and as you might guess, our two rulebooks have different ways of answering it. So IFRS likes to keep things nice and tidy with one single rule for everyone. You measure inventory at whatever is lower, its original cost or its net realizable value, which is just a fancy way of saying the price you think you can sell it for minus any cost to get it sold. US GAAP, though, it kind of has a split personality here. If a company uses FIFO, it follows the same rule as IFRS. But if it uses LIFO, it has to use a whole different test, the lower of cost or market.
And this is where it gets a little more complex. Under US GAAP's special LIFO rule, figuring out the market value isn't so simple. You have to juggle three different numbers. First, you find the replacement cost. Then you have to figure out a ceiling, which is the NRV we just talked about, and a floor, which is the NRV minus what you'd normally make as profit. The final market value you use is whichever of those three numbers falls in the middle. It's definitely a more involved calculation than the straightforward IFRS approach.
Okay, on to our next key difference. Imagine you've written down the value of your inventory because the market took a nosedive, but then the market bounces back. So what now? Can you reverse that write-down?
Under US GAAP, the answer is a hard no. Once you write it down, that's it. That new, lower value is permanent. It becomes the new cost. Even if that product becomes the hottest thing on the market a year later, you cannot write its value back up. That loss is literally locked in forever. But on the flip side, IFRS is way more flexible. It says, hey, if the market conditions that caused the write-down in the first place have improved, then yeah, you can and you should reverse that loss. That reversal goes right back onto your income statement, boosting your profit. The only patch is you can't go above the original loss you took.
So we've talked LIFO, value measurement, loss reversals, all this technical stuff, but why does any of it actually matter? Well, because this isn't just theory for accountants. This stuff directly hits a company's financial statements in a big, big way.
At the end of the day, these rules can change the whole picture. Banning LIFO, like IFRS does, can make a company's cost of goods sold look a lot lower during times of rising prices, which means it looks more profitable.
And allowing loss reversals, that can make earnings for an IFRS company jump up and down a lot more from year to year. And of course, the different rules directly change the value of inventory on the balance sheet. For companies in the US, there are even huge tax consequences tied to these choices.
This quote really nails a critical point. If you're an analyst comparing two companies, one using IFRS, one using GAAP, you might see much bigger profit swings for the IFRS company. And it's not because their business is less stable. It's simply because their accounting rules allow them to recognize a market recovery. It's the same economic event, just told in a different language.
And that really leaves us with this final big question. All these technical rules prove that financial statements aren't just a perfect photograph of a business. They are a story. And the rules, the grammar of that story, are shaped by the accounting standards being used. So the next time you look at a balance sheet, it's worth asking, what are the rules behind these numbers? Thanks for tuning in.